Jason, have we seen the bottom in the near term? And I ask this because investors are looking past a devastating jobless claims report, which is the closest thing we have to real-time economic data. And they're also responding positively to a vague tweet from the president on oil prices.
Scarlett, my own view is that bottoming will be a process. I know this is a cliche, but I do believe it's true. I do believe we've probably seen the lows, but I also just recognizing how unusual this is in terms of economic activity, shutting the economy down by fiat, by choice, and also the problems that you're going to have, long-term problems you're going to have in the credit markets. It's hard for me to think that, you have the all clear here. I think you're going to have a couple more months of extremely volatile markets, and it wouldn't surprise me if we retested the lows again. But a lot of damage has been done already very quickly, so that's good. It's easier to go through this ground the second time around than the first, but by the same token, I would be careful about reading too much into one day's moves.
Yeah, Jason, I mean, that's a good point. So, Jason, when you look at the moves in the market that we're getting on a day-to-day basis, and you try to sort of look a little bit further out, deeper into this year, what specifically are you going to be looking for that would maybe give a little bit more of a signal, not necessarily where the market is going, but really give you a signal of where investor sentiment is at, a picture that's maybe a little bit more complete, a little bit more reliable? Yeah, well, we have, I would say, we have a group of indicators, 10 indicators. I won't go through them all now, but of what we're looking at to determine when expectations for global growth have bottomed. And so some of them are copper, oil, the yield curve, credit spreads. Then there's some qualitative things in there like school closings, unemployment claims, and the like. The problem, I would argue, is that up until when the last time we did it was Monday, 5 were still deteriorating. 4 seemed to be stabilizing at a decent level, or at a low level rather, and only 1 was improving. So those things, I tend to try to look at market indicators more than anything else, because ultimately I think prices have a beauty in them, in that they're very objective. And so copper, oil, unemployment claims, I would think the yield curve, those would be 4, and credit spreads, maybe if I give you 5, just things that are relatively easy to measure, that you could measure on the Bloomberg, things to give you some indication of when global growth expectations are bottoming.
Okay, so that's a pretty big dashboard, Jason, that you're keeping your eye on here. One thing that, as you're ticking through these indicators, that really reminded me is how much things have changed just in the way we behave, how companies behave, how investors behave as a result of this crisis. Which of these changes in behavior do you think are permanent versus temporary? I know that you pointed out how consumers will be saving a lot more of their money, their income. Is that a temporary thing, or will that be permanent?
I think, Scarlett, what I think I realized in this is that everything, not just the financial sector, but all sectors are somewhat fractional reserve sectors, which is to say that, not everyone reserves for all the terrible things that could happen to you at any given time. And that's true of consumers. And we've gotten very accustomed to being able to not reserve more for bad times because of the benefits of globalization and the rest. My own feeling, and I take no pleasure in saying this, is that globalization is going to take a hit. And I think if you believe that contributed to stronger growth and lower inflation over the past 20 years, which I do, it seems likely that it will lead to somewhat slower growth and somewhat perhaps higher inflation over the longer term. I think consumers, too, Americans are generally, in the past 50 years, have not been particularly great savers. Since the last global financial crisis, actually, that's changed a bit. Consumers actually saved a bit more, despite the fact that the unemployment rate was moving lower. And that was, I think, because of the drama surrounding the global financial crisis. It seems to me people are going to have to save a bit more this time around, as well, even more. You get 6 million jobless claims, 10 times higher than anything we've seen ever since 1982. I think people are going to have to save a little bit more for a rainy day. And so some of the more discretionary items, I think, are going to be under pressure for quite some time.
Well, I mean, on that note of saving, I mean, if you broaden that out to the investment community here, what's your outlook going forward for the fixed income market? Typically a traditional place where a lot of folks do look to save money.
Yeah, I mean, I think, listen, I think this is manifestly deflationary in the short term. No two ways about it. So I would imagine there's going to still be a pretty strong bid for treasuries that will continue for quite some time. I do think there's going to be a very wide dispersion of returns, though, in spread-related product, and that'll be from everything from munis to corporate credit. And so, you know, strong balance sheets will be rewarded, and those spreads will be lower, and they'll do fine. But the funkier stuff, I think, is going to have a almost permanently higher cost of capital. Now, the Fed is buying securities that it's never really been able to buy before, and that will help. It stops the bleeding. But I do think the cost of capital for more marginal credits is going to be permanently impaired. I mean, at least for the foreseeable future.